Okay, guys, so today we're looking at accounting equation from November 2023 Gauteng for grade 10, paper 1. And we start with our question. It says, analyze the following transactions according to the headings provided in the answer book. The business uses a markup of 50%. So we are going to note that and we'll remember that as we go. Assume that the bank balance is favorable for all the transactions, and then they gave an example. So we've got 5 transactions there, and we're going to go into them right away. But before we do that, I want to explain there are things that I've written on our answer book here. The first one is I've written the word dead click. I hope you can see it right there. Dead click. This is something that I came up with that can help you to remember the accounts. So each account has its own balance. So for example, D is for debtors, E is for expenses, A is for assets, and the other D is for drawings. All these accounts that make up this letter, this word dead, they are all debit accounts, meaning that they increase on the debit side and they decrease on the credit side. What that basically means is if you want to increase any of these accounts, you show that by debiting, and wherever this account is being decreased, you show it by crediting. Now, the opposite is true for the other side, which is the click side. There, you've got your creditors, you've got liabilities, you've got income, and you've got capital. Those 4 types of accounts, they have a credit balance, which means whenever you want to show an increase in any of these accounts, you show that by recording them on the credit side, or in other words, crediting that account. And if you want to show a decrease, you also do it by doing the debit side. Then owner's equity is iced. So I've also put this here. Now, owner's equity iced means that whenever we are looking at owner's equity, we can look at it in terms of these 4 things. I is for income, C is for capital, E is for expenses, and D is for drawings. Those are the 4 items that make up owner's equity. So whenever you are analyzing your transaction and you want to see if this falls under owner's equity, you check with this iced. All right, let's go to the first question. Bought equipment on credit for 10,000 Rand from Swane Furnishers. So we have to ask ourselves 2 questions each time we have a question like this, guys. We have to ask ourselves where, and then we have to ask ourselves why. Now, these 2 questions are going to help us to find the 2 accounts involved. In every transaction, there are 2 accounts involved. We call them contra accounts, which will give us the entries. So let's go again. Bought equipment on credit for 10,000 Rand from Swane Furnishers. So there was an exchange of money there. Where did the money come from? It was on credit, meaning that the first account we are dealing with there is creditors control. Then the second account we are going to deal with, we are asking why was that transaction done? It was to buy equipment. So now we've got 2 accounts, equipment and creditors control. Now let's look at them in terms of their nature. Equipment has a debit balance as we saw on dead click, which means that every time it increases, we show that by debiting it. And when it decreases, we show it by crediting it. Let's see, is equipment increasing here? We bought equipment, meaning that we now have more equipment than before. So since equipment is increasing, it should be debited. Hence, you see they have already put it there for us. Now, the other entry is going to be creditors control. And why do I say creditors control? That's because this amount was not paid. This money was not paid. It was done on credit. So we are going to pay them later. So the account affected here is creditors control. How much is the transaction for? 10,000 Rand. All right. Then let's look at where does it affect. Now, equipment is assets. So assets are increasing because we now have more equipment. So it's a plus. What about owner's equity? In this transaction, do we have income? Do we have capital? Do we have expenses? Do we have drawings? No. So we don't have that. So it's going to be 0 over here. And then liabilities. We've got creditors control. Our liabilities are increasing. Then we go to the next one, number 1.2.2. A debtor, which means someone who is owing the business, N Motusi, paid 4,750 via EFT in settlement of her account. What does this mean? The account was for 5,000 Rand. So it means there was a discount there of 250, because when somebody settles their account, it means they have paid everything. But we can clearly see that there's a difference of 250. So that automatically means that was a discount. So let's look at which accounts are involved. Of course, there is a debtor, so there is debtor's control that is affected. And then there is EFT, which means there was a payment into the bank account. So there is debtor's control and a payment into the bank account. So debtor's control is decreasing because a debtor has paid. So the amount of debtors will go down. And according to DebtClick, debtors has a debit balance. We show a decrease by crediting it. Hence, you see debtor's control is already on the credit side. Then the other account is going to be bank, because bank has received the money, and bank being an asset, it increase. To increase it, we show by debiting it. So we are going to come here and write bank. So bank has increased by what amount? What amount was paid into the bank? 4,750. Now, that's just half the transaction, but let's finish it and see what happens. So bank is increasing because it has received money. Under assets, we put a plus under assets. But under assets as well, debtors control is decreasing. So we put a minus. So there's a plus and a minus together, because these two things are happening within the family of assets. And then owner's equity is a 0, nothing is happening there. And liability is also a 0, nothing is happening there. Then we move on to the next one. I told you this was half the transaction, because the other half is involving the discount. So the other money, we know that debtors is still reducing. So we are writing here debtors control. And at that time, we wrote the 4,750. This time, we are now coming to write the remainder, which is 250. Now, what other account? Because this money was not received, so we cannot say bank. It was a discount. So we will write the name of that account. It's discount allowed. So because of space, I'm not going to write the allowed, but you know it's discount allowed there. Then discount allowed is an expense, so it is affecting under owner's equity. And when expenses increase under owner's equity, it's a decrease. Then debtors control is also decreasing here. By the way, when expenses increase under owner's equity, what happens to the wealth of the owner when expenses increase? He now has less money. So that's what we mean by that negative. And then liabilities are not involved, so it's a 0 there. Then we move on to the next one. Sold goods for cash, the cost price was 3,000. By now, you guys know that whenever we sell goods, there are 4 accounts that are affected. It's 4 accounts and not 2. I'll explain why. If we sell goods for cash, the first transaction, as we can see, is sales, because we sold goods. And then there is cash, which is bank. However, what we sold is what we would have referred to as trading stock before selling it. So our trading stock automatically goes down when we make a sale, because what we are selling is literally the trading stock. So it's not possible to make a sale without affecting trading stock. So whenever we have the transaction of sales, we must also record what has happened in terms of our trading stock, that it has reduced. So let's record the first half and we'll come back and record the second one. Hi guys, sorry to disturb your video. I'm just here to discuss with you 3 ways in which you can support the channel. Number 1 is to watch the ads. So guys, the ads that come before the video, during the video, and after the video are linked to this particular video that you are watching. If you don't skip the ads and you actually watch, we're going to be rewarded by the advertisers. Then number 2 is to invite me as a guest speaker to your event at your school, a school function, prize giving day, revision classes, and so on one, I'll gladly come. Number 3, we've got the Masterclass Level Up program, which is designed for all those who want to write their exams in May and June of 2025. We are covering 3 subjects: accounting, business studies, and economics. All the information you need is in the description box below. Now let's get back to the video. Now, what is happening to bank? Bank is receiving the money. So since bank is receiving money, we say that it is increasing, and to increase bank, we know we debit it. That's why you see bank is the account debited. It was already entered for us. Then automatically the account being credited will be sales. And there's something to say there about sales. Remember, sales is has a credit balance. It's part of that click. It's an income. So since it has a credit balance, it increases on the credit side. Whenever we want to show an increase in sales, we show it by crediting the account. And how much are we recording the sale for? Because according to our transaction, we are told the cost price was 3,000. We are not told about the selling price. So we need to work out something here. Remember, we were told in the question that our cost price is 50, our markup on cost is 50%. But let's start with our cost price. We know, guys, that cost price will always be equal to 100%. Then we are told in this case that our markup is 50%, which automatically means that our selling price is going to be 150%. So let's take, for example, what we were told. We were told that the cost price was 3,000. Now, markup, which is 50% of that, is going to be what? 1,500. And that means the selling price is going to be 4,500. That's just simple math there. If the cost price is 100%, which is your 3,000, markup, which is added on top, in this case is 50% of that, which is 1,500, and then the selling price will be the addition of the two, which is 4,500. So this is our figure that we are taking to record here. 4,500 is for sales. And then we said bank is increasing, so assets are increasing. Sales is an income, it is part of owner's equity, so it is increasing owner's equity. Then liabilities are not involved. Then let's go to the second part of the question. The second part of the question, I told you we have sold trading stock, and trading stock always goes with cost of sales. Remember this, guys. So the other account here is trading stock. We are saying trading stock has gone down because we sold something. So we need to show that in our books that our trading stock is no longer the same. And the trading stock always goes at the cost price. Hence, you see the amount of 3,000 has already been written for us. Now, trading stock is an asset and is going down, so assets are going down. Cost of sales is an expense. And when expenses increase, the wealth of the owner decreases. So owner's equity is decreasing, and then liabilities are not involved. Let's go over to 1.2.4. The owner took trading stock at the cost of 850 for personal use. So we ask the same questions, where and why. We can see the owner there. The owner means it's drawings. And then he took trading stock, so trading stock account is involved. Now, trading stock has been taken at the cost of 850 for personal use. So trading stock has decreased. And how do we show a decrease in an asset like trading stock? We show it by crediting it. Hence, you see trading stock is the account credited here. Now, the contra account of that is drawings. And drawings will automatically come over to be the account credited. So drawings there and trading stock 850 is the amount. Trading stock is going down because it has been taken out. So assets are decreasing since trading stock is an asset. And then drawings is part of owner's equity. Remember, I said it's ICE, which is income, capital, expenses, and drawings. So from there, we know that drawings decrease the owner's equity. So it is also decreasing, and owner's equity is 0. By the way, guys, if there's anything that is not clear or that you don't understand, please engage with me in the comments. I'll be happy to respond to you and make sure you understand it. Then let's go to 1.2.5. The owner of the business returned damaged goods to the supplier. They were discounted by 5%. The original cost was 1,800. So very simple, guys. There are many ways of doing this, but this time let's choose an easy way. Let's calculate that discount first. So we calculate 5% of 1,800. We are going to get, our answer is 90, which means that we are going to deal with the amount less 90. The owner of the business returned damaged good to the supplier and they were discounted 5%. The original cost price was 1,800. So we are not going to use the original cost price. We are going to use 1,800 minus 90, which will give us 1,710. So we are going to go and enter. Trading stock has already been entered. Because we are returning it, it is decreasing. And then the contra entry for that is going to be creditors control, because we had bought these goods from our supplier on credit. We have to reduce the amount that we are owing for creditors control. In creditors control, being a liability has a credit balance, which means to increase it, we credit it, to decrease it, we debit it. So we want to decrease it by this amount. So we come over here and we record our creditors control. Now, how much is it? 1,710. Now, what is happening? Trading stock is decreasing, and then owner's equity is not involved. Then creditors control is involved. It is decreasing. Now, you will notice from all the transactions that they fulfill the accounting equation, because accounting equation says assets is equal to owner's equity plus liabilities. So assets is one side, owner's equity and liabilities are one side. So whenever you've got a plus on assets, then you will have a plus on either owner's equity and liabilities and so forth, because it has to balance. It has to be a plus plus or a minus minus, except for 1.2.2, where you will see that we had a plus and a minus on assets only, which amounts to a zero because it's subtracting and adding the same amount. And then we also have zero on the other side of owner's equity and liabilities. Thank you so much for watching this video. Watch out for more accounting videos coming your way. If you have not subscribed, please subscribe so that you don't miss out on more of this content that we will be releasing in the coming weeks. I will see you next time. Thank you and God bless you.